Hello and welcome to The Explainer. Today we're jumping into a really fascinating investment puzzle centered on the pharmaceutical giant AbbVie. We're going to look at it through the lens of a Warren Buffett-style analysis, and what we find is that a seemingly wonderful company might not be the simple, straightforward investment you'd think.
So the analysis we're looking at kicks off with this classic Buffett phrase, calling AbbVie a wonderful company at a fair price. I mean, that's pretty much the highest praise you can get in the investing world. But, and this is a big but, the final recommendation isn't a simple buy.
So right away, we've got a puzzle on our hands. If it's such a wonderful company, why the hesitation? What's the catch here? To figure this out, we've got to dig in and really understand what makes AbbVie so great in the first place, and, more importantly, where the risks might be hiding.
Okay, so first things first. Let's explore what actually earns AbbVie that wonderful company title. What's the secret sauce here? What makes their business so strong?
Well, AbbVie has what you'd call a classic business moat. Think of it like a castle protected by these massive, impenetrable walls. For AbbVie, those walls are built from rock-solid patents on life-saving medicines in really specialized fields. This intellectual property creates these huge barriers to entry that keep competitors at bay.
Now, what's really interesting is how AbbVie has navigated the dreaded patent cliff. You know, when a blockbuster drug's patent expires, as you can see, they've pulled off this brilliant pivot away from their aging megastar, Humira, to these new growth engines, Skyrizi and Rinvoq. And get this, they've secured their market position with these new drugs all the way out to 2037. That's some serious long-term planning.
And boom, this chart right here shows you just how well that pivot is working. I mean, look at that explosive year-over-year growth from their new drugs. This is a crystal clear sign that their strategy isn't just theory, it's paying off in a huge way.
Now check this out, an 84% adjusted gross margin. That number is just incredible, and it's a huge tell. It screams pricing power, which is a direct result of that strong business moat we talked about. They can command high prices because their medicines are unique and incredibly important.
So, you've got the super strong business, but what about the people running the show? A great business needs great leadership. So let's see how the management team stacks up.
And from what the analysis shows, this management team is absolutely firing on all cylinders. They're transparent, they reward shareholders with things like dividend increases, and they make these really smart strategic acquisitions that strengthen their core business. They're not getting distracted chasing growth in unrelated areas. That's discipline.
Okay, so let's recap. We have a powerful moat and really smart management. At this point, this feels like a total slam dunk investment, right? Well, not so fast. This is exactly where our investigation takes a very sharp and very important turn.
Let's pivot and look at the company's books because there is a massive billion-dollar red flag hiding right there in plain sight on the balance sheet.
And here it is, the plot twist. A total debt load of nearly $69 billion. That is a staggering number, and it's one that you absolutely cannot ignore.
Now, at first glance, you see a number like this, a return on equity of over 137%, and you think, wow, this company is unbelievably profitable. But as we're about to see, this incredible number is directly tied to that mountain of debt we just saw.
So how is that possible? Well, it's a result of something called financial leverage. That's basically using debt to juice your returns. Think of it like putting the company's performance on steroids. Yeah, it makes the numbers look amazing, but it also comes with some pretty serious risks. It's a double-edged sword for sure.
So, the crucial point to understand is this, that extraordinary ROE isn't really a pure signal of how great the business is performing on its own. It's more of a symptom of that extremely high debt load, which is artificially inflating and magnifying the whole calculation. In fact, the leverage is so extreme that it completely distorts some of the traditional financial metrics we use. Get this, the company's book value, its net worth, on paper, is actually negative. That's a really rare thing to see, and it's a telling sign of just how much debt is weighing on the balance sheet.
Which brings us to the final and maybe most important piece of this puzzle. We know we have a wonderful business, but we also have a very risky balance sheet. So the big question is the stock cheap enough to justify taking on all that risk?
So let's look at the valuation. Is AbbVie undervalued? On paper, a lot of the signs point to yes. You look at these key valuation metrics and they all seem to suggest that the stock is trading for less than it's actually worth. But here's where a core principle of value investing comes into play, and it's absolutely critical. The higher the risk you take on, the wider your margin of safety needs to be. You need a bigger discount on the price to make the risk worthwhile. With AbbVie's huge debt, a small discount just isn't going to cut it. All right, so we've got all the pieces on the table. A great business, smart management, a ton of debt, and what looks like an attractive price. So how do we put all of that together to come up with a final verdict?
This summary table just lays out the core conflict perfectly. Look at the top two lines. The business moat and the management get glowing positive grades. But then you hit the financials, and that gets a mixed grade because of that dangerous leverage. And that, in turn, makes the valuation neutral because the seemingly cheap price is basically canceled out by all that risk. And all of this leads the analysis to a final recommendation of hold. The takeaway is that it's a great company to own if you're already an investor, but given the risk profile, it's a tough call to start a brand new position at today's price.
So, if there's one thing to really take away from all this, it's this crucial balancing act between a fantastic business and a risky balance sheet. AbbVie is a perfect case study. The quality of the business is undeniable, but the price might not fully compensate you for the financial risk you're taking on.
And that leaves us with a final thought, a question for your own investment philosophy, and it's one that every single investor has to answer for themselves. Is a wonderful business enough to make you overlook a risky balance sheet? How much risk are you really willing to take for quality?